Good afternoon, or possibly good morning, depending on where you are listening to us from today. Welcome to another edition of Advanced IRA's webinars. Today, we're going to be talking about precious metals and really kind of looking at today's market with our guest presenter, who will be coming on in a few minutes, really talking about how precious metals kind of compare to some of the other assets that people find inside of retirement accounts. My name is Scott Maurer. I'm the Director of Business Development here for Advanced IRA. I've been with the company for a number of years. I'm a licensed attorney in the state of Florida. And during my time at Advance, I've really done a lot of different things. I've helped people with their different investments and going through the transactions, and whether they're buying precious metals or real estate or some other type of asset. I spend most of my time now really focusing on the business development side of things, teaching classes, and helping to head up our team here at Advanced IRA that brings you these great webinars that we have on a weekly basis. Just for those of you who are listening live today, I want to make sure you know that there is a question box on the GoToWebinar screen that you can use. So any questions you have for myself or for our guest presenter today, please type those questions into the question box. We'll make sure we get those addressed during the course of the webinar today. If you're someone who's listening to the recorded version, my contact information is here on this slide, that if you have any questions about self-directed IRAs, you can certainly reach out to me, and we'll certainly have the contact information as well for our guest presenter. You can reach out to him with any questions you have regarding precious metals. So as we go through the presentation, I like to always have to share our disclaimer that Advanced IRA and its employees we do not provide investment advice or legal or tax advice, and we certainly don't endorse any products or investment providers. So it is completely up to you to do your due diligence, not only on the types of assets that you are purchasing, but who you're purchasing them from and who you're transacting within your IRA account. If you do need referrals to an attorney, possibly a tax advisor, maybe a financial advisor, there are contacts that we have that we could introduce you to that could help guide you through the investments you're making within your self-directed IRA account. Just a little bit about Advanced IRA. We've been in the industry almost 20 years now. We have over $2 billion in assets under management across our almost 10,000 clients that we have between our offices in the Tampa Bay area and also in Atlanta, and certainly clients all over the nation, and even a few that are overseas as well. We try to set ourselves apart in two ways. One is the educational events that we hold, like the webinar that we're doing today, and also our concierge style personal service, where you get each account that comes in, each person that comes into Advanced IRA gets appointed to a specific account manager who's dedicated to helping them with anything they need regarding their account, from making their transactions to getting statements and anything else that they may require. We do have a great learning center as part of our educational events. Like I mentioned, the webinars that we do, 1 or 2 a week, are always available on our Advanta On Demand channel on YouTube. You can access that from our website and click on the YouTube link and find all of our recorded webinars. So even the one that we're doing today is recorded. Every other webinar that we've done for the past several years, and even for the rest that will come up this year, are all recorded and placed on that library for playback. So if you're listening live and want to go back and hear something that you missed or weren't quite sure of, you can always go visit that site. And obviously, if you're listening to the recorded version, you are on our page. So poke around, you can see a number of other different educational events that we've held as well. When we talk about self-directed IRAs, and in the context of today's presentation, we're talking about investing with precious metals. We're going to be talking a lot about precious metal investing in general, but obviously with Advanced IRA, we're talking more specifically about using a self-directed IRA or 401k type plan to make those investments into precious metals. We've seen a huge uptick over the last several months, not coincidentally probably, and I'm sure Greg will talk about it when he comes on with the inflation risks and the inflationary issues we've had here in our country have driven that demand for buying gold and silver and other types of precious metals through a self-directed account. But just so everyone's on the same page, if you're considering using some of your retirement funds to invest in precious metals or other types of assets for that matter, the types of accounts that you can self-direct, is always important to understand what kind of money can actually be used in this capacity. Any type of IRA. So if you're an individual and you have a traditional or a Roth IRA, if you own your own business and have a SEP or simple IRA account, you may, if you're a sole proprietor, that SEP IRA gives you just basically a larger contribution limit. But really, any type of IRA can be self-directed regardless of who the funds are currently with. Also, any former employer plans. You worked for a former employer and had a 401k plan. Maybe you used to work for the school board, you had a 403b, 457 plans, thrift savings plans for federal government employees. All of those accounts, once you leave that employer, are eligible to be rolled over into a self-directed IRA and then used to invest in alternative assets. About the only type of an account, the type of retirement accounts that you may be restricted from using are those current employer plans. So if you are working for your current, if you have a 401k through your current employer, a lot of times they do restrict moving the money out of that particular account. Now, there's always a couple of exceptions to that. If you're over the age of 59 and a half, you should be able to access that money, even in a current plan. And sometimes your plan may have some other exceptions that allow you to move money out even while you're still employed. But again, importantly, it's again to note any former employer plan, you can absolutely move that money and roll it over. So any type of IRA, any type of old 401k plan or employer plan, and we also offer health savings and education savings accounts. And while those are not retirement accounts per se, they share some of the tax benefits that the IRAs do, and they follow the same investing guidelines as well. Now, again, our presenter is going to go into much greater detail on some of this going forward, but the types of precious metals investments that are out there, certainly, and I think what we're going to be focusing on a lot today, are really the coins that are minted by certain government agencies, like the gold and silver American Eagles, the Canadian Maple Leafs, those types of coins that people like to invest and purchase with their IRAs or even non-IRA accounts. Also the bullion and bars. So these are basically physical, wanting to hold or purchase physical precious metal investments, whether it's the coin or whether it's the bullion and the bars. In addition to those options, you can certainly invest in gold and silver and in precious metals in certain ETFs on publicly traded markets, or even buying, some companies will sell you paper gold and gold certificates. I know that a lot of people, though, are a little nervous about making that kind of investment. That's why we wanted to have Greg on today to talk about really investing in precious metals when we're talking about really the left side of the screen, investing in coins, investing in bullion and bars as well. Now, a couple of keynotes on investing with an IRA before I bring Greg on to give us a much larger overview. Just note that some metals don't meet the IRS defined fineness requirements. So it is important when you're working with your precious metals dealer that you're buying from that they understand what coins, what bars meet that IRS fineness requirement. Typically, the metal that you're purchasing needs to be at least 99.5% pure gold or pure silver. There are other types of precious metals products. I kind of use that term a little loosely, but there are other products where the metal is not up to that same fineness requirement, and those do not qualify as IRA investments. As well, also, just because a coin was minted by a government does not automatically make it qualified for an IRA. Now, certainly, again, the American Gold Eagles or the American Eagles, the Canadian Maple Leafs, those are all permitted. There are a couple other governments as well that are acceptable. Make sure, again, that you're dealing with a precious metals dealer who understands what metals are permitted inside of your IRA account. One other note, this is talk about a court case here, McNulty v. Commissioner. This is something that a court case that came down just a year or two ago that was a little bit of a, not necessarily a surprise to some of us in the industry, but it did cause a few ripples. But that case of McNulty v. Commissioner involved an IRA owner who had purchased precious metals using an LLC. So they set up an LLC structure for their IRA account. That's something, if you want to learn more about that, we have whole webinars dedicated to that. But the IRA owner used a single member LLC with themselves as manager to purchase precious metals. And then when they purchased the precious metals, they physically stored and possessed those metals in a safe in their own house. And the IRS rules stipulate very clearly that if you are buying precious metals inside of your IRA account or with your IRA funds, you personally cannot have physical possession of those metals. And in that case of McNulty v. Commissioner, the McNultys thought they could use an LLC to get around that particular rule, and they found out, unfortunately, the hard way that was not the case. So just note, if you're looking at buying metals inside your IRA, you do have to have those metals stored in by a third party depository institution. Advanta works with a number of different institutions we could always give you a list for you to choose from, and I'm certainly Greg might have his opinion on some of those as well. All right, so just that was a little bit about precious metals, a little bit about self-directed IRAs, but this time I want to bring on our guest presenter. Greg Allen founded Allenhouse Metals in 2017. They offer the purchase, sale, and storage solutions for many different types of precious metals, and he's been a frequent speaker. We had his father on before as well, talking about investing in precious metals and what you need to know as far as that market goes. A little bit of personal background. I don't know how much he'll share with us on this, but he played professional hockey for 4 years. He worked for the Toronto Maple Leafs in Hockey Canada, and also has an online financial literacy program. So Greg, I'm going to turn the presentation and controls over to you. How are you doing this afternoon?
Awesome. I'm doing great. Thanks, Scott. And thank you again for having us on again. We love these. The webinars are just fantastic educational tools. So thank you for having us back.
Oh, you're welcome. And yeah, and you guys have provided great information. And so I'm sure, again, today's presentation is just going to be an extension of that. Again, I would just encourage anyone who's listening live, make sure to get your questions typed in the question box. As Greg goes along, I'll be monitoring those and get those questions asked. So
for sure. And just to further that point, please don't hesitate. There are no stupid questions, because I think, the more we get questions across here, the better everybody's going to understand what we're going over. There's a lot of moving parts to precious metals investment, so I know it's a normal thing. There will be, a lot of questions that may pop up. And so just to get into things here, I just want to start at the top with going over a little bit about, who we are. And so one thing that I wanted to touch on at the top, and something we take very seriously, right, is when it comes to investing in precious metals, just like any other investment, something that's very important to us is we want to make sure that we understand your investment objectives, that we understand your risk tolerance, so that we can get you the best precious metals product that fits your situation, right? There is no, one thing fixes all here, okay? And the other thing that I just wanted to touch on right off the bat here, and I know we were speaking about this a little bit a few minutes ago, when it comes to the question, I get this all the time, coins or bars. And the big thing is, I will say at Allenhouse Metals, we specialize in what's called investor bars. So these are kilogram and 100-ounce bars of gold, silver, and platinum. When it comes to investor bars, the reason they're called investor bars, they carry the lowest premium that you're going to get, right? Coins all have more intricate minting involved in them, especially once you get into the graded and collector coins. These don't necessarily follow the precious metals markets. And so what we find a lot of the time is people go down a road where they're buying beautiful coins. Don't get me wrong, they're absolutely beautiful, but they don't necessarily provide the return on investment that a lot of people think that they would. And so the reason that we're going with what's called investor bars is because all of these bars have a serial number on the front. They have a QR code on the back that you can scan with your phone to verify their authenticity with the mint that they come from. And because of this, they all garner a premium buyback. And what that means is that your metal retains its value. You're not going to come back to us and find out that suddenly the premium value of the bar has just up and disappeared. And aside from that, the big thing is we want to get you the best bang for your buck. So just moving forward here, a little bit about us. So we are a registered dealer with Dill. I don't know if anyone here has heard of Dill before. Dill is one of a dozen authorized purchasers for the United States Mint, but they're one of 2 purchasers that has designation for virtually every government mint in the world. Okay, so just to break this down and explain it, since 1976, Dill is responsible for purchasing and fronting the money to all of these government mints around the world to then import the metal into the United States. And they're the ones that distribute the metal to the major banks. They're the ones that distribute the metal to a select number of approved registered dealers like Allenhouse Metals. And they also will deal with jewelers and miners because they're a refinery as well. So what we're able to do by dealing with Dill Engage is we're able to get many products that most other companies just don't have access to. We have a lot of exclusive products. The other thing is we're able to allow customers to buy directly from the inventory of Dill Engage. You're paying lower premiums. And what we're effectively trying to do is just cut out the middleman. And so just to touch quickly on what I was saying about not having heard of Dill Engage before, they are institutional facing only. They do not, without going through us, you can't just go to Dill Engage and purchase precious metals from them. So that's a significant feature there. And moving on, I know Scott was talking a little bit about that case that we had with the gentleman McNulty who had an LLC where he tried to take his metal home in an IRA. When it comes to depositories, and there's a handful of different companies that have accreditations across the country. The one that we use is IDs Texas. So IDS is International Depository Services. They're a wholly owned subsidiary of Dill Engage. Okay, so the big thing about IDS and IDs Texas and why we use them is the storage facility is actually located within the same building that the warehouse for Dill Engage is. Now, this is a massive plus, and the reason is your metal doesn't have to be shipped. There's no insurance that has to be bought for the shipping. There's no lead time in shipping. Your metal quite literally gets put on a pallet in the warehouse and walked over to the auditing room within IDS where they audit to make sure it's all authentic. And so this ensures that on both the buy side and the sell side, you're able to complete transactions and liquidate much quicker than you otherwise would. A lot of metals dealers unfortunately require you to physically ship the metal back to their physical location from the storage facility in order to sell, and it just adds on unnecessary time. So the other thing everyone will see here, all of the precious metals that's held at IDS is insured with Lloyd's of London. And as well, they have just about the cheapest fees in the industry. Quite literally, to store $100,000 worth of metal there, it's only $100 a year. It's cheaper than keeping money in the bank, literally. So we, as I said, we wholeheartedly recommend IDs Texas for that reason. Now, moving forward here, just starting to get into a little bit of analytics here and portfolio allocation. What we're looking at here on the far left in the pie chart where you see 75% and 25%. This is an allocation for what some might refer to as a permanent portfolio. And what a permanent portfolio is, it's a portfolio that's designed to perform positively in all economic conditions. So whether we've got recession, geopolitical tensions, turmoil, or whether we have a booming economy, the permanent portfolio is one that's designed to provide consistent results. Okay, so if you look at the legend, the permanent portfolio is recommending 25% in precious metals, and 75% in other investments, whether that be stocks, real estate, bonds, and the like. It's an allocation that's been adjusted over the years, but this is actually the results of a study done by CMP Group over 50 years from 1968 until 2018. And what they established was that over that time period, investors who had 25% precious metals averaged 10.23% returns over a 50-year period. That's annually. And the significant factor is this was what they characterized as a, quote, much smoother ride. This was consistent returns. It wasn't massive ups and massive downs. And that's the primary reason for the recommendation of this allocation. If we turn and look at the right, where we're suggesting an aggressive investor has about 10% precious metals and roughly about 7.5% in bonds and fixed income, the rest being in stocks. What's important to note is this is an allocation that's recommended for someone who has a minimum of 4 streams of income. Now, to look to the far right, we have the allocation of Ray Dalio's, sorry about that. We have the allocation there of Ray Dalio's portfolio. For those of you who don't know who Ray Dalio is the founder of Bridgewater. They are the largest hedge fund in the world. And he is a massive advocate for gold. He is 7.5% of his multi-billion-dollar portfolio in precious metals for this exact reason. So moving on here, one of the major reasons why people allocate funds into precious metals from their portfolio is the safe haven aspect. It's quite literally the safest, most conservative thing you can do. And really, and what I want to get back to, aside from consistent returns, the reason that investors look to precious metals is because they want to store a value, they want to protect their purchasing power, and they want to offset risk that they face in other investments, right? Nobody is saying here for 1 second, as you would see from the pie charts, no one's saying for 1 second that you should put everything you have into precious metals, right? We all know the best strategy when it comes to investing is not to have all your eggs in one basket. Diversification is the key to success here, right? So moving forward, right, if precious metals are a safe haven, how do we find precious metals react in economic downturns and recessions? So one thing, and I just mentioned this, right, precious metals is guaranteed to rise over time with the cost of living, being inflation. So what does that mean? What that means is if you bought gold 100 years ago, all of the money that you put into gold, that gold will buy you all of the goods and services today that it bought you 100 years ago. All of the silver or gold that you buy today will buy you the same goods and services in 100 years from now, regardless of inflation. And so that's what we mean by that. Now, during high inflationary periods, right, which we've experienced a few years of this now, precious metals typically rise and stocks plunge. Now, one of the major things that we look at in this, aside from the valuation of things, and I get this question all the time, is, you know, why would I invest in physical metal instead of something like an ETF, an option, or futures? First off, options and futures are incredibly risky. You could lose your shirt, your house, and your left kidney investing in those. So we won't even get into that. But specifically, I always get the question of, should I invest in GLD or SLV, which are the ETFs, or should I invest in physical metal? Now, as of 2020, we have started to see a mass exodus of investors out of GLD and SLV, the ETFs, and into physical metal. The reason being is the prospectus for GLD and SLV was changed in 2020 because of the supply and demand crunch in precious metals. I believe it was either page 7 or page 9 of the SLV prospectus they changed. And what they changed was they no longer have to back the fund with purchases of physical metal. The other thing that they changed is they can now liquidate the fund without investor approval and just give investors liquidation value. Now, the significant thing about this is the factors that caused those ETFs to follow gold and silver prices so closely was the fact that they would back your purchases of units in the fund with purchases of physical metal. Without them doing that anymore, and actually before I get ahead of myself, there used to be a clause where you could actually take delivery of some physical metal once you met a certain threshold of ownership in the fund. Now, without the purchases of metal backing the fund anymore, what this means is the fund does not follow the prices of gold and silver as closely anymore. In fact, what it's subject to is simple volume, right? If people aren't buying units in the fund, the price of the fund isn't going up because it's not backed by what it used to be backed by. So moving forward here,
Greg, if we can, I just have a quick question for you to step in on that. So
sure.
with the ETFs, I mean, how many, I guess, what percentage of people do you think actually know the background of that? I mean, obviously, I'm sure people who are, really very sophisticated investors, obviously know that same information you're talking about with the ETFs, but the general public, is that something that's just not really publicized? I mean, what percentage of people do you think would have no idea that that's the case with an ETF?
Honestly, I would tell you that probably only 5% of people know about that. The reason is those 5% of people are the industry experts.
Right.
I get these questions, because a lot of the time we'll have customers looking to diversify their portfolios, and their first thing to look at, because they can do it from their account that they currently hold, their first thing to look at is ETFs, right? Because if you have a trading account, it's real easy to just buy one of these ETFs. So the issue, and the reason why more people don't know about this, and I appreciate you asking the question, the issue is when these prospectuses were changed, there were not news headlines. There was not press releases. They simply changed 4 different paragraphs within the prospectuses that are published every year. But let's be honest about it, right? How many regular average investors are reading the prospectuses that the funds release annually every year? I don't know of anyone, right? So
Right.
it is something that isn't totally known, but I try to make it known just because it for me, that's a significant factor that would make me sit back and think a little bit. And something that should be advertised and should be known when you're going to make a significant investment into something, right?
Absolutely. That's why I asked the question. So yeah, that's a great answer.
So just moving forward here, and really, so this chart as well, this is going to come from that 50-year CMP study. What this is tracking is both the nominal price and the real price of the S&P and of gold over the last 50 years, ending in 2018. Now, one is adjusted for inflation, the other is not. But what you're going to see over both, while we have different peak points and different valley points for both the S&P and gold, gold consistently outperforms the S&P 500. Now, just to get a little bit into depth about the allocation, I know I went over the pie chart, but I just wanted to expand a little bit for everyone because, the question is, I know I stated the return, but why specifically 25%? Why is that the target allocation? And so what we see in this chart, this is effectively a risk-reward ratio. The portfolio that they're quoting here is one that has gold, the S&P, and T-bills or cash, T-bills being interchangeable with cash in their study. Now, what you're going to see on the left, the axis on the left is going to be your return percentage, and the axis on the bottom is going to be the percentage of risk. Now, what you're going to see, and it outlines right there, is the target allocation and the optimum allocation is between 25 and 30%. Okay, what you're going to see is, people who held between 25 and 30% in their portfolio, in this case, are going to average just below 8% a year. If you look over to the right, it'll show you having, 70% is producing over 9% returns annually. So a lot of people would say, hey, well, why wouldn't I just put 70% in there? Reason being, the reason that they are going to recommend 25 to 30% is if you have 70% in gold, you lose out on the potential higher returns from riskier speculative investments year over year. And so what they found was 25% to 30% in gold mixed with either T-bills or cash, and the rest in S&P produced not only the most consistent, but gave you access to enough risk where you could potentially yield higher rewards over time. So moving forward here, and this, now we're going to get into specifics with, what exactly happened last year in the equities market. So one thing I want to touch on just before I even go into analyzing the chart here is the S&P lost 19.89% on the index for the year 2022. So that's $8 trillion in market cap. Now, I want to just reference the difference that you're going to see, because a lot of news headlines were quoting 18.11%. The reason that there's a difference in that is the S&P last year paid a dividend of 1.62%. So the 19.89% figure I'm quoting is the loss of the index in market cap and as a total price. However, if you include the dividend, it was a little less than 18.11%. Still, significant loss. We're almost in bear territory with that. Now, just before we get into the chart and analyze it, the other factor I want to get into here, and this is something, I'll be honest, that is surprising to a lot of people, is the dividend percentage over 90 years in the 20th century for the S&P averaged just above 5% per annum, okay? And so this was significant because a lot of people would invest in the S&P, not just because it's a large cap index, but also just because it produced an income, right? If you're earning over 5% in dividends plus the appreciation of the stock, you could produce some decent returns and you could live off the income from it. What we've actually seen since Alan Greenspan became chair of the Fed years ago is these dividends have continuously been declining year after year after year. And so when we see the dividend wiped all the way down to 1.5%, it really takes the thought of income production out of the equation. And so I mention this because, we've seen a lot of large institutional and individual investors moving out of stocks like S&P and moving into assets like precious metals because the advantage to income production is no longer there. But what I would like to do, I just want to point this out on the chart. I know we just discussed the loss that we saw last year, but I just want to point out a technical term. If you see, we see there's a blue line running across the chart here, and there's a red line running across the chart here. The blue line is going to indicate the short-term 50-day moving average, okay? The red line is going to indicate the 200-day moving average. And so what we see, if you look, it's mid-March. If you follow it up from mid-March, it's in the top left-hand corner of the chart. You see the blue line cross below the red line. So when the 50-day, the short-term moving average crosses below the longer average, the 200-day moving average, this causes what's called a death cross. Now, this is not just for the S&P. This tool can be used across all charts and markets, but a death cross is quite literally the most bearish signal that we can see on a chart. And so I mention it because we saw significant losses after the death cross. These are tools that if you're ever looking at charts on your own, it's something that you can look at for sure. If you see the 50-day moving below the 200-day moving average, you have losses coming your way, and it's something that you want to keep an eye out for. Now, just moving on here, I want to go into some details here on, why did we see such losses last year in equities, right? We saw, the NASDAQ shed, it's tech-heavy NASDAQ, but they shed 33.1%. The Dow not as bad, sitting at 8.9%. And, we saw that significant loss we just went over in the S&P. And so the first thing that I want to mention is, if we remember, the Fed raised rates a total of 7 times for 4.25% last year, okay? Now, the big thing to think of, as much as I would like to think that individual investors like, you and I are the ones affecting volume in these markets, we're not. We're the little guys, right? What's moving markets here is larger institutional investors. And so what we see in terms of volume, when interest rates are raised, it costs more to borrow money. A lot of these institutional investors, these banks, the hedge funds, are trading on leverage or margin, right? And so as the cost of their leverage gets more expensive, the positions are closed out. So we see a loss in volume from that. Aside from that, we also see at each meeting, Jerome Powell hosts a press conference in which he gives forward guidance, right? We have another Fed meeting coming up here in just 2 weeks, and he's going to do the same thing again. He testified in front of the Senate today and gave more forward guidance. And so in the forward guidance, Jerome Powell telegraphs the moves that the Fed is about to make. So as we all know, right, the 7 interest rate hikes, the 4.25%, this was no shock last year. We had ample warning before each and every one. And so what you'll see is every time there's forward guidance given, there typically is a significant response from the market, because institutional and individual investors alike, if they're smart, will listen to what Jerome Powell's saying and adjust their investments to better prepare for what's coming. Okay. Now, the other thing I want to touch on, obviously, and the reason we saw interest rates raise so much last year was the rampant inflation. So if we look at 2022 as a whole, we saw 6.5% inflation. And now the important thing I just want to bring up is the interest rate hikes we've seen is by no means the end of it. And the reason I mention this, if we look throughout history, the Fed has never tackled inflation without matching the interest rate to the inflation rate or surpassing the rate of inflation with the interest rate. So if we see inflation at 6.5%, the data would suggest that in order to get control of inflation, the Fed would have to increase above 6.5%. Now, last thing, and obviously, this had a significant toll here on the market, was the geopolitical tensions in the Russia-Ukraine war. Aside from just the geopolitical tensions, the war contributed to the massive supply chain issues that we've been experiencing for the last couple of years since that was originally brought on by the pandemic. And these supply chain issues obviously keep prices of things like commodities and obviously other things that we get everywhere from the grocery store to the car dealer elevated and exacerbate inflation. So moving forward here, if we look
Greg, if I can, I just had a quick question for you before you go into, like, I see you're going to talk about silver, but I had a question come in from one of the viewers. And again, if you're listening, please get your questions in. A question came in and says, why should I invest in metals if the government and the central banks artificially suppress the price of gold and silver via the paper commodities market? Basically, in other words, if gold and silver is traded via paper, there is no indication that the paper is linked to the gold inventory. So just wanted to get your thoughts on that. Again, encourage anyone else to ask questions as we go along.
For sure. No, I think that's a great question. And to be honest with you, it's one that I don't think gets asked enough. I would say the bigger manipulator in past years of the gold and silver market has not actually been the central banks. It's actually been JP Morgan Chase. We actually recently just had a ruling. JP Morgan Chase was trading well above the leverage limits set by the CFTC and artificially suppressing the price of silver. The ruling has since forced them, as well as others trading above these limits, to come back in compliance with the limits as set forth by the CFTC. The other thing that I do want to emphasize, and the simple thing I would say when tracking the price of gold and silver, and I'm going to get to this later in the presentation, the main reason why we're looking at gold and silver right now, aside from inflation, aside from what's happening in US equities, is the US dollar. Okay, gold and silver doesn't do anything without the US dollar. They share an inverse relationship, and what this means, it's like a seesaw, right? So as the dollar goes down, silver goes up in value, and vice versa. I'm going to touch, I want to finish answering this, but I have an entire slide on it. And so whoever asked the question, I'm going to apologize to you now. But if you could be patient, I promise you, I believe we're 3 or 4 slides away, and I will get to that question in depth because it is a really good one. Just moving forward here, I just want to touch on what gold and what silver did throughout the course of last year. So we saw silver post gains of 5%. As you can see from looking at the chart right away, it was by no means in a straight line. We saw it move negative before it moved up positive. The major thing that I want to highlight with this is, why did silver move up? And the big thing is, I know I just said the US dollar is typically the #1 indicator of why gold and silver move up. Last year, and I will show you this, and this is a chart I want to get to, the dollar actually increased in value on the index. Obviously, we lost purchasing power because of inflation, but the dollar on the index and that basket of currencies increased with the interest rate hikes. So what we saw last year is we saw, obviously, the price of silver specifically didn't exactly follow, but closely followed the rate of inflation. The other 2 reasons we saw significant increases here are, #1, supply and demand. Right now, the demand for silver far outstrips the supply. Quite literally, between the new demand we have in electric cars, green energy with solar panels and such, the demand is in excess of 400 million ounces to what the world is going to produce this year. And so obviously, when you have supply and demand in a pinch like that, we can infer what that's going to do to the price. The other thing is, in times of geopolitical tension and war, we see elevated precious metals prices just because people flock to safety. Now, what I wanted to point out in this chart, aside from that, and this is something that that will become relevant, and if you want to see more updated charts, you are always welcome to call in, and I would be happy to show you the update. But what we saw near year end right here is the opposite of what we saw in the S&P. The S&P, we saw what was called a death cross, right? So this is the opposite, where we see this blue line here on the right side of the chart, right near the end. The blue line crosses upwards of the red line. So the blue line being the 50-day moving average, the red line being the 200-day moving average. When the blue line crosses north of the red line, it forms what's called a golden cross. This is quite literally the most bullish factor that we can see on a technical chart. And again, it does not just apply to gold or silver, the S&P. This is across all charts. So just moving on, and I wanted to touch on this here as well. We say a small gain of 0.004% in gold, but let's be honest, it remained flat for the year, okay? And gold being, as I've written down there, gold is the most common crisis commodity, right? Now, the one thing that I always say when I refer to gold compared to silver is gold is steady Eddie. Okay, so gold is not going to see the massive fluctuations that you might see in other assets, something like silver, right? It's going to be consistent year over year. And statistically and looking at charts, the people that, and investors as well, the people that typically buy gold are those who are simply looking for a store of value, a hedge maybe against the dollar and inflation. People who are looking right now at capital appreciation are looking more towards silver. But one tool that I wanted to get across to everyone here is, why do we see gold basically remaining even and silver up 5%? And I'll give you the reason why right now. It's called the gold to silver ratio. I don't know, I'm sure a lot of people may have heard of this before. The gold to silver ratio has been an indicator of value in precious metals markets, and gold and silver specifically, for the last 120 years. Now, what is the gold to silver ratio? It dictates how many ounces of silver you can purchase for every ounce of gold. Now, on average, in the 20th century, it was 40 ounces of silver for every ounce of gold. So the ratio is 40-1. On average in the 21st century, it's been 45-1, okay? And so what this means is if we see the ratio closer than 45-1, it means that gold is undervalued and gold is a better buy. If we see the ratio wider than 45-1, it means silver's undervalued and silver is a better buy. Now, when we look at 2022, the gold to silver ratio operated between a range of 78-1 and 93-1. What I want to be very clear about, first off, there is only maybe a dozen times in history where we have averaged 80-1 for an entire year. Okay, this shows that silver is incredibly undervalued. But what we know is whenever we've bought silver at a ratio of 80-1, it statistically outruns gold 4.5-1 on a percentage basis. Okay, and what we saw last year was just slightly over that 4.5-1 performance. Okay, now this is the chart that I was referring to, and this that I wanted to get to answer that past question. And this is the US dollar index chart. Okay, what I want to show is you will notice when we saw, if you look at the left-hand side of the chart, and I don't know if you can see my cursor, but the left-hand side of the chart over to 2020, we saw the dollar fall at start of 2021 effectively, all the way down to 89 on the index. When it fell to 89 on the index, that's when we saw silver hit $30 an ounce. Okay, then we can see if we move over to the territory on the right, where we're in 2022, we see it recoup and move all the way just under 115. Okay, now all this time while the dollar's moved up, silver, thanks to the supply and demand crunch, as well as the elevated inflation, still increased in price by 5%. What I want to point out by this is that the dollar has only spiked to that level that we saw from the rising interest rates twice before in history. Okay, it spiked to that level in 1985, and it was elevated at that level in 2002, 2003. Now, the reason why everyone right now is looking at the dollar and thinking about precious metals is because both times before, when the dollar spiked to this level, it immediately crashed, once by 48% and once by 33%. So that's an average loss of 40.5%. Okay, now what does this tell us? Well, we know quite clearly we can track the prices of gold and the prices in silver based on the performance by the dollar on the index. And so we already know that 89 on the index is going to show us in the neighborhood of $30 silver. We've seen the dollar on the index fall back down to around 105. It shed, roughly 10% already. But if we look at the statistics, we know there's still roughly 30% on the table for it to fall. Where does 30% put it? Well, it's going to put it in the low 80s or high 70s. Low 80s or high 70s, that's going to show us above $30 silver. So if I'm looking at factors as to why do I buy silver regardless of everything that else is going on in the world, I'm looking at the US dollar. And if I'm a betting man, right, we've seen this happen only twice before, and the same thing happened both times. If I'm a betting man, I'm not betting against 100% odds. And so just moving up onto the chart, the one thing that I do want to show everyone, if you look at this, there's a black line in the top of the chart you see moving up and down. That's what's referred to as the RSI, the Relative Strength Index. So what this tells us is it tells us when you're in the green, when a stock or a commodity or something is sitting in a normal range. If it gets up into the high end near 70 or above 70, that indicates that it's overbought. If it gets Below 30, that shows that it's oversold. Between typically 35 and 65 is where you want to see it if you're purchasing something. If we look at the dollar, we see a massive spike when it ran back up to 105 here, and it ran right up to 70, showing it's overbought on the index. Now, what this shows us is that this temporary bounce we see is more likely than not what's called a dead cat bounce, and we are soon to resume the dollar's fall into negative territory, which is, as I was saying, a positive for metals here. At the same time, though, as we all know, it is a negative thing for having cash in the bank, right? As the dollar loses value, if we look at inflation just last year, if you had $100,000 sitting in the bank, that's a loss of $6,500, right, in purchasing power. So I just wanted to touch here on, we touched a little bit on what we've seen here in the past, what we saw last year. I want to touch on, what we're looking at for this year. And significantly, I do want to mention this. Powell came out and spoke to the Senate today. So what I'm about to say is not in this presentation. What we know is he has promised the Fed will be data driven. Okay, they're going to respond to the data accordingly. And what this has implied and what he said today is he is going to be more hawkish at the next meeting than originally anticipated. A lot of people have said, oh, well, they're done raising interest rates. And unfortunately, it's quite clear they're not. 17 of the 19 governors and Federal Reserve Bank presidents at the Fed see interest rates above 5% for the remainder of 2023. And this makes a lot of sense. If we look back to what we were just saying, right? The Fed has never conquered inflation without matching the interest rate to the inflation rate or surpassing it. The majority of those officials also see that rates are going to sit above 4% through 2025. The other significant thing we look at, real estate, also another great area to invest in, but with elevated interest rates for this long, it may take a lot of those potential purchases out of the equation. The cost of borrowing money is going to be much more expensive, not to mention what we see in the equities markets, the cost to leverage is much more expensive for those institutional investors. We have Mike Wilson. So Mike Wilson is the chief U.S. equity strategist, at Morgan Stanley. Morgan Stanley and Mike Wilson are informing all of their clients. They believe the stock market, specifically citing the S&P, is in what's called the death zone. They believe that the prices are completely out of whack after we saw a small rebound at the start of the year this year. And they're forecasting losses of 26% in the equity market this year. Moving forward, Michael Burry and Ray Dalio. I don't know, I'm sure everybody here, once I explain it, will know who Michael Burry is. If you've ever read the book or watched the movie The Big Short, The Big Short was written about Michael Burry. Michael Burry is the individual who called and bet on the housing market bubble and the market crash in 07-08. Michael Burry is forecasting, quote, the mother of all crashes this year. He is warning everybody, if you can, do so now, exit the equity markets and rebalance. It's time because of what's coming down the pipe. Ray Dalio, the founder of Bridgewater, the largest hedge fund in the world, we were just talking about him. He's actually in a rush the last 3 months negotiated a retirement package to completely sell out of his fund Bridgewater that he's built over the last 30 years and retire. And so I bring this up because Ray Dalio and Michael Burry have much better track records than the average investor. Michael Burry has called things that nobody could foresee happening in a million years. If we have seasoned professionals and market leaders like this making moves and sending out warnings like this, it would be wise to think about them for a second and potentially follow that advice. Now, what do we see for the year with gold and silver. If we look at all the leading analysts, specifically one that you'll see come up in the news a lot is Philip Streibel. Their forecast for silver is an average price of $28 an ounce for 2023, with certain moves above $30. They forecast gold at $19.50 an ounce, with certain moves above $2,000. Now, I bring this up because if we look at this on the charts, currently we see silver sitting just above 20. So this would be a move of roughly 40%. That's right in line with what we were looking at with the decline in the dollar. And if we look at the move in gold, we're seeing a move of roughly just around 10%. And so the other thing I want to point out, if you remember, we just talked about the gold to silver ratio. Silver outrunning gold 4.5 to 1 on a percentage basis on average when it's 80 to 1 or wider. Well, these projections as well are citing just that silver's going to outrun gold 4.5 to 1 on a percentage basis. No one's saying 10% returns are bad. Don't get me wrong. Those are fantastic returns, but it's showing that, we'll see gold with steady increases, and they're projecting the big moneymaker this year to be silver. So just in wrapping up, and what I want to emphasize here, the big thing that I want to emphasize at Allenhouse Metals, we are not doing anything. We're not flying by the seat of our pants. This is all based on market research, and they're all based on results. And at the end of the day, we want to make sure that we do what fits your investment objectives the best. We are available Monday to Friday from 9 a.m. to 8 p.m. Eastern Standard Time. And at the end of the day, if you have any questions whatsoever, even if you just want to sit down and look at some specific charts in more detail, we are happy to help. If you have metal even if you have metal that you purchase from someone else and you can't seem to offload it, because there are dealers out there that don't buy back, give us a call. We will help you liquidate. We ensure that, all of our customers and people that come to us, we will do our best to make sure you're going to get top dollar on the way out as well. And what I wanted to offer as well is anybody who's on this webinar, if you call or email in and you reference the webinar, we will make sure that you get a discount on your first purchase. Our number is listed right up there, and that's going to be my direct email to reach me. Please do not hesitate to reach out.
Hey, Greg, thank you very much for the presentation. Very informative. Love the data. It's always helps drive the conversation, show exactly what it is that you're talking about. So as we get ready to wrap up here in a minute, again, if anyone wants to get any last minute questions in, we can get those in the box. I'm going to ask whatever pops up to Greg here. Greg, I'm assuming you guys can work with people. I know you're based here in Florida like we are, but we work with people all over the country. I'm assuming you do as well.
Yep. So we're able to work with people all over the world. We even have, through Dill Engage, we have facilities in Austria and Singapore as well, in Asia. And we do actually have clients who are in Europe as well. Obviously, being located here in Florida, though, I would say about 90% of our clientele is, US based.
Gotcha. Okay. A question did come up from one of the viewers that said, how do we often, and I'm not sure exactly what they're asking, I'm going to ask the question, then I'm going to have a follow-up to it too, but how often do we monitor this account? And maybe that's just a larger question as well. For someone who's investing in precious metals, how often should they monitor their holdings? I mean, I think most people who are buying gold and silver, it's not like buying stocks where you might be a day trader. It's a longer play, but how long though? If you're looking to buy something, is it I'm buying it and just forget about it for the next 5 years, or is it something you should look at every so often?
I think that's a great question, and the reason is, just like you said, there's a huge psychological difference too in the attitudes that you take to precious metals investing versus investing in equities. Typically with our customers, we like to have a review every quarter. I would say every 60 to 90 days. Reason being, even if you're looking at these, typically gold and silver are longer term investments. While we're in a situation right now with a high inflationary period where you can make more money in a shorter term, and you could look at it as a shorter term investment, The significant thing is we see changes in things like the gold to silver ratio and changes in supply and demand crunches with premiums and everything quite frequently. And so the reason that I recommend looking at it every 60 to 90 days is when there's changes in the market, sometimes we'll change our strategy, and we can always exchange different types of metals. So for instance, we can exchange gold for platinum, platinum for silver, silver for palladium. And these are things that we do by looking at the data. And what I would say is we typically review with customers every 60 to 90 days just to stay up to date and make sure we're on top of everything.
Okay. The person said thanks for that answer. So I'm trying to think if anyone else has any other questions. Again, please get those asked into the question box. Certainly if you can come up with something afterwards, you don't want to ask the question here live on the webinar, you can certainly reach out to Greg here. I've always found Greg very available, very quick to respond. So I'm sure anyone reaching out to me get the same response from him. So any questions I think you have just obviously on buying the metals or maybe just questions on the markets themselves. Yeah, it's a little odd time out there right now, obviously, with where the markets are at and inflation and some predictions coming in like Michael Burry's, and then there doesn't seem like everybody else. Some people are not in a crisis mode. So, but as you said, gold and silver could be a place just as a safe haven. I guess a question I had, maybe I asked it earlier, but what percentage of people, you said that 25% is kind of the ideal, or maybe where you should have about 25% of your portfolio in precious metals. Do you think most people even come close to that when you first talk to them, Greg, or is it kind of people a lot less than that?
I would say, and to be honest, this goes back to the ETF thing we were talking about with the change in perspective. I find the people that have looked at the studies and read the data will typically have anywhere from 15 to 25% from the point of actually analyzing the data and realizing that this is something tried and true over the course of the last 50 years. It's not just something that we came up with on a moment's notice. But the average investor, I would say absolutely not. It's something that we help a lot of people do. We do it every single day, but definitely not. And the one other thing, Scott, I just wanted to get this across to everyone, whether you're dealing with Allenhouse Metals or not, please, 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 if I have any advice, stay away from graded or proof coins. Just don't do it. The thing is, at the end of the day, what will get sold to you is something that they will say it operates on a different market. It doesn't go down with the price of silver, but it moves up. But what we find, and I've spoken to other custodians as well, the average markup on these products is in excess of 70%. And when you go to sell, it's not like you're buying and selling bars with us where you're getting your premium back. When you go to sell these products, a lot of the time people are taking haircuts. We have clients who have seen the market move up 50% and still lost money buying from other companies with graded coins. So I mention it just because I do take a special interest in making sure if it comes to metals, you do the right thing. Please don't get talked into these nonsense schemes about these graded rare coins.
Yep. Well, very good, Greg. Thank you again very much for your time and coming on today. Really appreciate it. I'm sure everybody that was on enjoyed it. So if you have any questions, again, Greg's information was up there for a little while. My information is here if you have any questions. Please don't hesitate to reach out to me, reach out to Greg, and we'll hopefully have Greg. Hopefully, we'll have you back on here later in the year. Maybe we'll see what some of these predictions, if they're starting to come to fruition, or how the markets are moving at that time. I think it'd be great to have you back in 6 months or so and take another peek at it.
100%. I'd love to do that. So sounds like we'll make that a plan.
All right. Thanks again, Greg. Thanks everyone for listening today. Again, if you want to watch the recording of this webinar, it'll be up on our YouTube page within a day or so. So look forward to having everyone else on our other events. Thank you.
Thank you again for having us, Scott. Thanks everyone for coming.
All right. Thanks, Greg.